Today, November 10th, 2025, Bitcoin approaches $11,000 as the week closes. Meanwhile, Alex Thorne of Galaxy reveals the reasons that led him to cut his year-end Bitcoin price forecast by $65,000. Major cryptocurrencies are posting slight gains at the week's close, moving counter to equity stocks, which remain pressured by new declines in the tech sector and economic data that has fueled investor concerns. In recent hours, Bitcoin has touched the $11,000 mark. Ether gained just under 1%, while Solana's SOL token posted a gain of over 1%. This move coincides with consumer sentiment data approaching historic lows. The news comes just a day after the Challenger Gray and Christmas report highlighted that October layoff announcements reached their highest level for the month in over 20 years. Looking at the weekly performance, Bitcoin marks a decline of about 8%, registering consecutive losses, and its fourth negative week out of the last 5. Bitcoin's price is sitting approximately 20% below its 52-week high. Over the same period, Ether is down nearly 15%, experiencing its worst week since February 28th of this year, when it lost over 16% in 7 days. Solana isn't faring any better, with a drop of over 16.5%, its worst weekly performance since the beginning of February. Let's now focus on the market's main story. This week, Galaxy released a new report updating the year-end price target for Bitcoin. Talia Gopal met with Alex Thorne, head of global research at Galaxy, who explained in detail the reason for the $65,000 reduction in his forecast. Thorne also analyzes the elements behind the recent volatility in the crypto sector. In your latest report, you revised your year-end Bitcoin target downward, bringing it to $120,000 from the initial $185,000. That's a significant difference. This week, the crypto market obviously experienced heavy selling, with Bitcoin falling below $100,000 for the first time in 4 months. How much did this impact the recalculation of your target, and what other factors played a role? Actually, this week's price swings had a limited impact. The decisive factor that pushed us to revise our projections was rather the leverage wipeout that occurred a few weeks ago. On October 10th, that episode substantially compromised the liquidity profile in the short term. The $185,000 target had been set last December 31st, 2024, after the October 10th crash. An 85% rally in the next 6 weeks now seems unlikely. It's certainly a significant revision, but it applies to the period between now and the end of the year. That original target was influenced by the wave of optimism following last November's presidential election, when Bitcoin was the most bought asset globally, practically the most popular investment between the election and President Trump's inauguration. That's no longer the case today. It's no longer the dominant trade. Your observation is pertinent. It's interesting to note that your new target of $120,000 is even lower than the record Bitcoin hit just a few weeks ago, when in October it reached $125,625. Bitcoin is volatile by nature. But what do you believe were the triggers for the decline in recent weeks? What is fueling the sales in November? In an interview, Tom Lee of Fundstrat cited some recently accumulated pressures, like the government shutdown and last month's hawkish Fed rate cut, which weighed on the sector. Do you share this analysis? I consider those contributing elements. However, the main breaks on Bitcoin this year have been, in my view, the massive redistribution from large, long-term holders to new entrants. We are talking about approximately 470,000 Bitcoin transferred from wallets inactive for over 5 years to new owners. It's a huge volume of distribution. In value terms, in 2024 and 2025 combined, at least $100 billion worth of these dormant coins moved on the blockchain, an unprecedented scale. This immense supply has to be absorbed by the market. The positive side is that it has been absorbed, which demonstrates solid demand for Bitcoin, also driven by ETFs and institutional investors. It has been a clear headwind. Furthermore, if at the beginning of the year Bitcoin was the top-performing investment globally, the same cannot be said for much of the rest of the year. Sectors like AI, nuclear, quantum, and gold have captured attention, diverting capital away from Bitcoin. I am convinced that interest will return to Bitcoin, as it always does. But this has created alternatives for those seeking returns. We are entering a maturation phase. This transfer of ownership is healthy for broader distribution and lays the groundwork for future growth. We maintain a positive outlook. But with only 6 weeks left in the year and an uncertain economic context, Bitcoin appears unstable. There is a lack of sustained bullish momentum, and the technical indicators are not favorable, to put it mildly. There is room for a further decline, but I believe around $90,000 strong demand would kick in. If it were to drop towards $95,000, roughly half of the network supply would be underwater, a critical line for the bulls to defend. You mentioned AI. Wall Street has also shown volatility, with investors beginning to question valuations in the AI sector. Is this a negative signal for crypto, considering their correlation with tech stocks? Absolutely. AI has driven much of the stock market gains this year, particularly the so-called Magnificent Seven. It's a crucial factor for any investor to monitor, even in crypto. Although we believe Bitcoin is evolving towards a role as a hedge against currency debasement, a sort of digital gold, this process is not complete, and the market does not yet fully treat it as such. Therefore, the AI trend carries weight. However, I see substantial differences between the current AI boom and the dot-com bubble. In the 90s, the government's approach was more focused on education and access to information. Today, AI is considered a geopolitical necessity, almost a national security issue, with unprecedented public investment. Furthermore, technological progress has been rapid. 2 years ago, AI imagery was rudimentary. Today, it's photorealistic. We don't yet have AI agents managing our lives, but a leap forward in consumer utility could surprise everyone to the upside. It's important to emphasize that Galaxy's research team maintains a bullish long-term view on Bitcoin. In the report, you highlight the growing institutional legitimization of the cryptocurrency. What do you think will be necessary to reverse the current trend? And on what timeline? Yes, a sturdier foundation is needed after the October 10th shock, when 35% of futures open interest was wiped out. These adjustments take time, and they are not unusual within a general bullish trend. We are finally seeing major wirehouses opening up access to ETFs through wealth management channels. Morgan Stanley is the most notable example so far, having authorized its advisors to recommend initial allocations of up to 4% in Bitcoin ETFs. It's a crucial step. It's been almost 2 years since the spot ETF launch, and the segment that needed this access vehicle the most is finally starting to turn on. This will create structural, passive, long-term demand that will support prices in the medium term. 2026 is shaping up to be a complex year to predict. I'm not ready to issue a new target for the end of that year yet, but I can anticipate it will be higher. We look forward to the new target for 2026. Another widely discussed topic is stablecoins, especially after the passage of the Genius Act. Cathie Wood of ARK Invest stated that stablecoins are taking on some of the functions she thought would belong to Bitcoin, and she has trimmed her bullish estimates precisely due to this competition. In your report, you note how the growth of stablecoins is redirecting venture investment towards fintech and payments infrastructure. In what other ways is this renewed interest changing the crypto narrative? It represents a maturation and evolution of the sector. Personally, I see stablecoins more as an extension of dollar dominance than as a tool for consumer payments, although that latter aspect will also be relevant. Most investors in Bitcoin in recent years have been attracted by the digital gold and scarcity narrative, not the medium of exchange narrative. I'm not aware to what extent that second narrative factored into Cathie Wood's thesis, but stablecoins do not compete with Bitcoin as a hedge against dollar debasement. They don't alter the money supply. Their story is tied to expanding the distribution of the dollar and enhancing payment systems, both domestically and abroad. It's a big story for the crypto ecosystem and for integration with traditional finance. For existing banks and payment companies, this represents both a challenge and an opportunity, as shown by recent acquisitions of talent and companies specialized in stablecoins. It's an important trend that, while it doesn't directly impact my long-term thesis on Bitcoin, has undoubtedly absorbed some of the attention and investment that was more focused on Bitcoin in the past. All right. That concludes our update for today. We'll see you again next Monday. Have a great weekend, everyone.